It would not shock me that if silver goes to a new reality in a range that's a couple $100, maybe it goes to 500 first. Okay, why do I come up with that number? In an emotional burst, markets do that. Overcompensates and then settles back into the new reality. Pardon me the comment, the idiot price chart technicians say the range had been roughly $50 range for 50 years. I'm going to add $50 to the top of that range, not a ratio scale, but arithmetic. Oh, it says we're going to double and go to 100. That somewhere maybe around 100, you might get that little stumble. It's not going to be the top, especially if it occurs, in January, early February. It's too early.
Here's Shanghai is showing 84 and we're at 76. Anything there?
If they go up, we're not going down. You can expect that breakout of an 11-year wide base, not just to go up for a couple months. It's going to go up and stay up for a couple years. Don't be shocked if silver does a copper or a lead or what gold has done repeatedly over the last 50 years. So if gold goes to 8,000, where would silver be if it's just 2%? Tight.
$100.
Yeah, easily.
Paradox wants to know, he says, eventually, the silver bull run will end. What types of patterns in your momentum charts will you expect to see at the peak?
One, I don't think this time when it ends, you're going to have corrections, okay. But once silver goes ape and discounts a reality it should have been in before. Now, let me explain that. Silver stuck in a box for 50 years. $4 to 50, $4 to 50. Okay, tenfold range. You can look at a copper chart or a lead chart or a gold chart and go back to the 1970s and 80s, and you'll see there was a range that prevailed in copper and lead, for example, for decades. And then in 2005, copper broke out of that range and quadrupled in price in a couple quarters. In which it said, hey, I'm going to a new reality. And it did. And yeah, after that, there was a very sharp sell-off, but then it lived in a new range for decades, since 2006, for example, roughly either side of $4. Okay. The old range had been 50 cents to $1.50. So it lived in a range that was 4 times the price reality of its old price range. Yeah, look what happened there.
Silver hasn't been sleepy for decades. It's been structurally suppressed, and that distinction matters more than momentum oscillators. As Michael Oliver has argued, long-term compression creates explosive repricing once ceilings break, and silver's 50-year range is historically extreme. Copper's 2005 breakout wasn't speculative hype. It was a regime shift confirmed by supply stress and global demand, leading to a 300% move in under a year. Investors focused on short-term corrections missed that post-breakout volatility doesn't negate a higher valuation band. Portfolio risk here isn't correction risk. It's under-allocation risk if silver re-rates structurally. And as Michael Oliver warns, markets transitioning realities don't ring bells at the turn.
And that surge that took you up to $4 there, that first big explosion, if you break it down, you'll find it's literally a couple quarters once you cleared the top of that range. Couple quarters, okay?
Yeah.
Now, and the lead market did the same thing, but it did it a year and a half later. So they weren't correlated. And did the same sort of action where it went into a new reality and lived there. And when you look at gold, it expanded well beyond the 1980 high when it ran up to 2011. And then it pulled back, and then it's blown way beyond. In other words, it doesn't stay in a range like silver has. Now, why is silver still in the range of 1975 to 80 through 2011? Only just now has broken out in silver freshly, and it's only done it by a month or so. Okay? So this is fresh. Don't be shocked if silver does a copper or a lead or what gold has done repeatedly over the last 50 years, which is to say, blow out the old high by leagues. And gold, for example, the two bull market runs that we have in the last 50 years were both 8-fold moves.
What's quietly unsettling here is how late silver is relative to its peers, not how fast it's moving now. Michael Oliver has repeatedly noted that silver lagging gold for decades isn't stability, it's distortion. Gold broke its 1980 high, corrected, then multiplied again. Silver never fully repriced alongside it. That divergence matters for portfolios because catch-up phases historically compress time frames and magnify volatility. Gold's prior eightfold moves occurred without today's debt loads or monetary stress. If silver is only 1 month into its breakout, the risk isn't that investors are late, it's that they still underestimate duration. As Michael Oliver emphasizes, delayed markets often move hardest once they're free.
Bear low to bull high, bear low to bull high. Our bull market started from a low in 2015 at $1,050, in which case you go eightfold, you're going to be $8,500.
Yeah.
Just to match the ratio scale of those two prior bull markets. In which case, if silver's 2% of 8,500, again, gold just doing what it's done twice before, an eightfold move, and I don't expect that'll stop it, by the way. But then you run those silver spreads versus gold and say, where might silver be if gold's at 8,000 and silver goes to 3%, like it was in 2011?
$600.
You know, you're talking hundreds of dollars an ounce. And all of these metrics help tell us strongly silver is in a tantrum mode to catch up to a new reality that it's avoided for so many decades, whereas other markets have not. Yeah. This is not a normal move. Okay, what about the top? Okay. There are bigger factors going on here than just another bull market in silver. We have an asset class shift that just began out of the strong U.S. stock market, stronger than most in the world. It's a bubble. The monetary metals have broken out freshly.
Wall Street hears $8,000 gold and dismisses it as fantasy, but the math isn't emotional. It's historical. Michael Oliver frames this as ratio logic, not prediction, and that distinction is critical. Two prior gold bull markets delivered eightfold moves. Today, gold is barely halfway there despite worse fiscal conditions. Silver at just 2 to 3% of gold isn't aggressive, it's precedent. Meanwhile, equities trade at forward PE levels north of 20, while real yields stay unstable. This isn't a silver story alone. It's an asset rotation away from financialized risk. And as Michael Oliver cautions, when capital exits bubbles, it doesn't trickle, it surges.
You can expect that breakout of an 11-year wide base not just to go up for a couple months. Mm-hmm. It's going to go up and stay up for a couple years, if not more. I think the events that are about to unfold technically in certain asset categories like U.S. government bond market, Japanese bond market, UK bond market, we have a government debt crisis. And it hasn't really unleashed yet, and I expect it will at some point, probably in the next few months, where you get further downside in those markets. I'm talking long dated, like 30-year bonds.
Okay. And
a spike up in yields on the long end, despite what the Fed does on the short end. That will cause a major bubble-piercing crisis in the stock market. The central banks will have to print. Their primary focus will be on the bond market and help and save the stock market as well. They won't admit that. That helps what? Gold and silver, because they're degrading the money units underlying their markets. And that's further panic fuel for gold. Now, the question then is, what about the top in silver? Yeah, there will be a point at which, let's say after the next 6 months, silver will go to a new reality and possibly even overshoot what you could consider to be the new reality.
The real risk Wall Street won't say out loud is that bond markets, not stocks, control the endgame. Michael Oliver has highlighted that long duration yields rising against Fed policy is historically destabilizing, and that's already forming. When 30-year yields rise while short rates are managed, equity multiples crack. It's happened before. Central banks don't print to save metals, they print to save bonds. But the consequence is currency dilution. That's why gold and silver respond first, not last. Investors watching only silver charts miss the bond trigger underneath. And as Michael Oliver notes, overshoots aren't excess. They're how markets reprice decades of denial.
So if it's going to live in a range that's a couple $100, maybe it goes to 500 first. Okay, why do I come up with that number? If you take the last 50 years in silver, it was a tenfold range from bear lows to bull highs repeatedly. $4 or $5 lows, $50 highs. Tenfold. Take the dimension of that on a ratio scale and add it to the top of $50. 50 times 10 is what? Okay? You get the point. It's a simple swing measurement of the ratio scale of that range. It would not shock me that if silver goes to a new reality of several $100s, that in getting there, it goes past the new reality in an emotional burst. Markets do that, okay? Overcompensates and then settles back into the new reality. And also at that point, I don't know where we're going to be in terms of the major fundamental crisis that I just mentioned. The government debt bond crisis, the dollar dropping versus other currencies, which it's in the process of doing, the plight that might be suffered by commercial real estate, heavy in debt, long-term debt, not behaving well technically. All these events out there could create a new reality in terms of our fundamental assumptions about where we're going to be in a year or two.
The number sounds extreme until you realize it's not emotional, it's mathematical history catching up. As Michael Oliver points out, markets don't move in neat lines. They leap when decades of suppression unwind. Silver's tenfold swings weren't anomalies. They were repeated structural resets, and today's debt backdrop is worse than any prior cycle. Commercial real estate stress, falling dollar trends, and sovereign bond fragility all amplify overshoot risk, not limited. Investors anchoring to reasonable prices ignore how crisis repricing works. And what Michael Oliver warns next explains why these overshoots rarely give polite re-entry points.
We go into a new reality where maybe silver and gold become monetized here, there, suddenly spreading across the world. So that their new reality they stay in. Okay, get the point. This is not a normal bull market.
Okay, so basically, there's we've got a huge debt crisis, and if past is prologue, what's going to happen is, and the Fed has already started doing this. They've already started doing yield curve control. They're buying their own debt. Yeah. You see that increasing. It's one of the signs of that is going to be that they're lowering short duration interest rates, but the long end, like we could see on the chart I shared, is starting to tick up. So the yields are going up, meaning the bond market is going down. That'll be another one. And none of which those have really happened yet. So you're not worried about a peak yet in silver. We got a little ways to go.
Oh, no. I think silver's going to do what I said, broadly speaking. I can't define it perfectly, except to throw up some of those metrics on silver versus gold. Where has it been before? Hey, maybe we go there again. Why not?
This is where macro quietly overrides charts, and most investors aren't prepared for it. Michael Oliver has consistently flagged yield curve control as a sign of systemic stress, not stabilization. When central banks suppress short rates while long yields rise, bond prices fall, and that forces capital into hard assets. That shift doesn't require panic headlines. It happens through balance sheets and liquidity mechanics. If monetization spreads globally, silver isn't peaking, it's repricing. Portfolio risk here isn't volatility, it's misreading policy signals. And as Michael Oliver notes, these transitions only look obvious in hindsight.
Price just took out 50-year high. Where might gold go under a normal bull market? Eightfold. Oh, okay. Is that a big deal? No, you've done it twice before. Times are different now. Maybe it goes further. Silver ratio to gold, breakout versus the stock market. All of these are big macro technical events with underlying fundamentals, and they've just begun.
Okay. All righty. Got some more silver questions. Deep wants to know, have you heard about the Silver Institute leaving out military usage of silver with when they do their estimates?
I don't keep up with that data.
Okay.
There are people that debate about the validity of it and so forth, and we're just not involved in that. there's day-to-day stories about silver. Government's doing this, somebody's doing that, and so forth. There's bigger issues in play here. The big monetary factors in play due to fundamental errors that have been accumulated over the last decades that are about to unleash. So whether we have a problem on this exchange about silver deliveries and so forth and so, those are all the kind of events you'll hear all along the way, but they're not the primary drivers.
Breaking a 50-year high isn't excitement, it's structural confirmation. Michael Oliver emphasizes that when assets clear half-century ceilings, valuation anchors reset whether narratives like it or not. Gold's prior eightfold runs happened under milder fiscal conditions, making today's ratios more concerning for skeptics, not bulls. Supply debates and exchange rumors distract investors from the real driver. Decades of monetary distortion finally colliding with math. Long-term portfolios should focus on regime shifts, not daily headlines. And as Michael Oliver reminds us, noise always peaks just before fundamentals become unavoidable.
They're merely expressions of what's really going on under the surface, the bigger volcano. And so I think looking at those as some kind of spot-on metric, oh my gosh, I got to do something. No, this is far bigger. This is a volcano based on monetary government debt issues, the unviability of paper money for decades. It's merely created boom-bust cycles.
This is the line most investors skim past, and it's the most important one. Michael Oliver has warned repeatedly that surface indicators fail when systemic debt reaches saturation. Paper money hasn't stabilized cycles. It's amplified them, turning corrections into convulsions. When confidence cracks, markets don't respond gradually. They gap into new frameworks. Chasing micro signals during macro failure is how portfolios get whipsawed. The real question isn't timing trades, it's understanding the structure breaking underneath. And what Michael Oliver points out next reframes volatility not as danger, but as consequence.
Hey, I loved holding my neighbor's 10-ounce bar of silver. I got to get some of those. It's real. I can touch it, and it's going up. So that's the key. And I think the stock market's probably the factor there, because when it breaks, that's when the emotion really comes in.
Okay. We got another question here. I'm going to share my screen again, and it's about, let me do this. Okay, here's the silver chart. Greg wants to know, he says, how will the recent actions of the COMEX and the China silver war impact the price of silver moving forward? Will these factors
no thought on it. I know there's a lot of focus on the price difference between the two. And
here's Shanghai is showing 84 and we're at 76. Anything there?
That's fine. Believe me, if they go up, we're not going down. Okay.
Okay.
But this price action of the last handful of days is indicative of the nature of what kind of corrections you're going to see in the future. We had a huge percent drop from the peak there at 82 to the low just below 70 in a matter of 48 hours.
The real story here isn't COMEX versus Shanghai, it's how quickly fear collapses when the trend asserts itself. As Michael Oliver points out, investors obsess over venue price gaps while ignoring structural demand and velocity, which is where real signals live. A near 15% drop in silver in just 48 hours would normally trigger panic headlines, yet the market stabilized immediately, exposing how shallow selling pressure really was. Media fixation on silver wars distracts from the bigger driver. Reflexive behavior once equities wobble, and capital looks for something tangible. For investors, this means volatility is not risk. Misunderstanding it is. And next, Michael Oliver explains why these violent swings may actually shorten future corrections rather than end the move.
Yeah.
Then all of a sudden, where are you right now? You're trading at a price level that two prior peak closes closed at, just above 77, okay? You got above there today. So, on a close-only basis, you got hit, down, back up, back down, back up. This is not the way you top, by persistently going back to the same level 3 times. This beast is ready to launch. And I think that probably, and this is my own personal investment position, that in the process of getting to, let's say, a couple $100 in a matter of a couple of quarters, there will be a midpoint stumble. In fact, if you go back and examine those two other surges that both were capped at the $50 level,
Yeah.
somewhere in the middle of each of those surges, there was a stumble that no doubt upended. You see that little guy there, yeah.
Yeah.
Okay. Where there was, oh my gosh, that's got to be the top, and then they blew your head off again. Okay.
Yeah. Yeah.
Similarly, in '79, there was an event like that. But the point is that in the middle of this move that we expect, it wouldn't shock me to see some sort of midpoint where you could say, hey, that's not just a 2-day correction. It wasted 4 weeks, let's say.
The quiet detail here isn't the breakout. It's how repeatedly revisiting resistance usually precedes acceleration, not exhaustion. As Michael Oliver has pointed out, markets that fail to reject a level after multiple tests often signal unresolved upside pressure rather than distribution. In silver's prior major runs, mid-cycle corrections of 20 to 30% occurred without damaging the primary trend, and the 1979 surge showed a similar psychological shakeout before continuation. Investors tend to misread these pauses as tops because recency bias overrides structure. Portfolio-wise, this is where leverage gets punished while patient positioning survives. What comes next matters far more than the stumble itself. And as Michael Oliver emphasizes, emotional retracements are often the market's way of resetting weak hands before the next leg higher.
Yeah.
Let's say you drop and then you go sideways. It wouldn't surprise me if, pardon me the comment, the idiot price chart technicians say, oh, okay, the range had been roughly $50 range for 50 years. I'm going to add $50 to the top of that range, not a ratio scale, but arithmetic. Oh, it says we're going to double and go to 100. So it wouldn't shock me that on approach to a big round number, which seems to be the way they like to play the game anyway, big round numbers are gold and silver. They like to sell against them, see what they can do. That somewhere maybe around 100, you might get that little stumble. It's not going to be the top, especially if it occurs, in January, early February. It's too early in the process. But it wouldn't shock me that there's some kind of a little stumble there. Where, if you're invested in silver or silver miners, I wouldn't be concerned. But if you're in something very leveraged, very time sensitive, like call options, then maybe that's when you need to pay more attention. But right now, it is way too early to succumb to any 2-day drop, even of the dimensions we just saw. That was like a 15% drop.
Round numbers feel meaningful to humans, not to markets, and that mismatch is where mistakes compound. As Michael Oliver has warned before, arithmetic projections ignore ratio scale behavior, which is how real secular moves unfold. Silver's historical volatility shows that 10 to 15% drops are routine even in strong advances, and selling pressure near clean numbers like 100 often reflects positioning games rather than fundamental exhaustion. The risk isn't holding minors or physical exposure. It's being over-leveraged when noise hits. For everyday investors, this is a reminder that time, not precision entries, carries the edge. And as Michael Oliver notes, reacting to short-term price theatrics usually benefits traders, not long-term capital.
But bam, in 2 days, you're back up there again. So if you got out, where did you get back in? You get the point. You missed it, okay? But I think maybe around 100, it's what I'd call an idiot level, and it wouldn't be surprised to see some kind of effort there to, look, silver doubled, I'm out, okay. You'll miss the move if you get out, but if you're in calls, you might want to pay attention at that point. I will be.
Okay, yeah, I've been talking about that with my subscribers because I see a lot of technicians are basically taking, like you said, they're taking the last kind of cuppish pattern, flipping it and inversing. That level's 88. Then they take the big one, flip it and inverse it. That level's 96 or 100, right? So I got to believe that there's going to be some price action around there from simply that.
Could be, yeah. But if it occurs early, like this month, or early next, that's way too early in this liftoff process.
Yeah.
Again, there's too many examples of when a market goes to a new reality. It doesn't do it. It does it quickly, but it doesn't do it in 2 months. It does it in the span of a couple quarters. And again, gold isn't even at its normal eightfold move.
What rarely gets said is that technicians often manufacture certainty by flipping old patterns into new targets. Michael Oliver has repeatedly criticized this habit, noting that pattern symmetry often fails once markets transition into a new regime. When silver snaps back in days after sharp drops, it exposes how exits are driven by fear, not invalidation. Historically, secular moves reprice assets over quarters, not weeks, and gold itself remains far below prior magnitude benchmarks. Retail traders chasing double levels risk being shaken out while institutions scale patiently. The real danger isn't volatility. It's mistaking mechanical chart projections for risk management, something Michael Oliver consistently warns investors to avoid.
Heck, it's done it twice in 50 years under conditions that are far less horrendous in terms of fundamentals. And it's only fourfold? We're only halfway to where we were in those two bulls. So if gold goes to 8,000, where would silver be if it's just 2%? Get the point. Okay.
Yeah.
So hold tight.
$100.
Yeah, easily. And I think that's where we are right now. And so when I hear this constant chorus of that's the top, it's got to correct, got to go back to 50 or 35 or whatever they want, it just doesn't happen. And now the breaks, instead of being spanning a couple weeks or 3 or 4 weeks, like remember October, it wasted about 4 weeks there. This time it was 2 days. Okay, you get the point. Speed is the issue here.
The overlooked signal isn't price, it's acceleration, and acceleration usually appears late, not early. As Michael Oliver has observed, when pullbacks compress from weeks into days, it reflects urgency, not fragility. Gold's prior eightfold moves occurred under milder debt and liquidity conditions, making today's fourfold advance historically incomplete rather than extended. If silver merely maintains a modest percentage relationship, current narratives about the top ignore basic math and context. For portfolios, this means risk lies in underexposure, not in tolerating volatility. And as Michael Oliver reminds us, speed often marks the transition phase, the point where disbelief lingers longest.